Welcome to the Lauder Institute at the University of Pennsylvania. I'm Jules van Binsbergen, director of the Institute and a finance professor at the Wharton School.
And I'm Jonathan Berk, a finance professor at the Graduate School of Business at Stanford University. This is the All Else Equal podcast. Welcome back, everybody. Today, we're going to do an episode on a topic that Jules and I have spoken about repeatedly for, I would say, as long as we've known each other, which is the internal rate of return, and specifically using the internal rate of return as a criteria for making an investment decision.
Yeah, and Jonathan, I think that the use of the IRR is ubiquitous, both in the private sector as well as in academia. I mean, the number of finance professors today that essentially teach the IRR as a complementary decision-making criteria with the footnote that it may have certain problems, but still putting it almost on equal footing with the net present value or NPV criterion is quite shocking to me.
Yeah, so Jules, I teach the introductory finance class. It's a 10-week class. I spend 1 week on IRR and why it is a horrendously bad investment rule. And we wanted to talk about this. You and I have a paper, which we're almost done, on the IRR rule. And the paper makes a strong claim, which is that it's not exceptionally bad in a few cases, but it's always a bad decision rule. And that's a very strong claim. And maybe we can explain this on the show. So why don't we start, Jules, with explaining what is the problem with the internal rate of return?
Well, before we do that, let's take even one further step back, which is let's talk about the net present value and the IRR in terms of how they're defined. So generally, what we say is if you want to make a good decision, then you need to trade off costs against benefits. And so if you take the net of those two things, you get the net benefits of a decision. But of course, when you make a decision, generally the costs that you have are not arriving at the same time as the benefits. And so the field of finance is particularly equipped to address the issue of how do I trade off costs and benefits that don't happen at the same time? And the object that we use to trade those two things off is what's called the discount rate. And generally we say that if benefits happen further into the future and or are riskier, that means that you value them less as the risk goes up and as the time that you have to wait for them goes up.
And what we do in that case is when we bring all the cash flows to the present, all the benefits to the present, all the costs to the present, and we subtract. And what you called the benefits outweigh the costs. The word in finance is the net present value of the investment is positive. So that just basically says all the present value in today's terms of all the benefits exceed the present value of all the costs. And if that's positive, you make the investment decision.
Indeed. And so when we use the acronym NPV, it has the N for net, which means the net of cost and benefits, and then PV, present value, meaning that everything has to be comparable by bringing them all to today's equivalent in terms of value. And we use the discount rate to do that. Let's think about the intuition of what a discount rate does. So the way I always explain it in class is the discount rate essentially tells you how important the present is relative to the future. So if the discount rate is really low, that means that the future is very important to you relative to the present. If the discount rate is really high, that means that the future is not that important to you in your decision making. Now, the internal rate of return, or IRR, is already, if you think about it, an interesting object in and of itself, in that it is a thought experiment. It is a thought experiment that says, we have used a discount rate of, say, for example, 12%, but we're not going to be using that 12% number. We're going to do the thought experiment where we ask, what should the discount rate have been for the net present value to be zero? So nobody is arguing that that is the correct discount rate. No, we're doing a thought experiment where we're saying, how far could we push the discount rate in many cases up if the net present value was positive, so that then we can see how far we can push that discount rate to push the net present value to zero. So in a usual investment rule, it's that the costs come up front and the benefits come later. So that means that if for the discount rate that we're using, the NPV is positive, if I now start to push the discount rate up, I make the future, which has the good stuff happening, less and less important, which of course means that the NPV will come down. If I make the discount rate high enough, I make the benefit so irrelevant that eventually we will reach the break-even point where the NPV is exactly zero. And that's how the internal rate of return is defined. And some people take the outcome of that thought experiment itself as a decision rule.
So Jules, there's a very good way to use the rate that comes out of that thought experiment. Because you, in many, many cases, you don't know the discount rate very accurately. And what the thought experiment tells you is how far off can you be such that your NPV is zero. And so you can think of it as a break-even rate.
Yeah.
And that's a very useful thing to know. Because if you have a positive NPV project and it turns out if you're off by 10 basis points, and your discount rate is a zero NPV project, that tells you you better have a lot of confidence in your discount rate. But if let's say you need to be off by 5% in your discount rate, most likely you'll know your discount rate within 5%. And so it's a much more confident. And that's a very useful measure.
And so I agree that break-even quantities in general, when we do sensitivity analysis, when we make a decision, I think is a useful thing to do. We often think about the break-even price or the break-even quantity that we need to sell or the break-even tax rate. And in that sense, we can also think about the break-even discount rate. And actually, Jonathan, I'm happy that you bring this up because I think that is the perfect terminology for it. I don't think it should be called the internal rate of return. There's nothing internal or rate of return about it, in my opinion. It's just the break-even discount rate. That's a much better name for it.
Exactly. The IRR investment rule works like this. Invest whenever the internal rate of return exceeds the discount rate. That's the rule. Now, the problem begins when we use it in another sense. We say, well, if the discount rate is less than the break-even rate, that must be a good deal. And so we use that as a rule to make an investment.
So now, Jonathan, we are not the first ones to bring up that this thing may have problems, and other people have pointed out that in certain cases, the usage of this internal rate of return can have problems. And so let's list them very clearly. So the first one is, because we're asking for a rate that makes the net present value zero, if the cash flows, the net benefits that we are using don't have a nice pattern and they switch signs, that means that this thought experiment can have multiple answers. So it's possible that, you get a break-even discount rate where the NPV is zero at 14%, at 27%, and at 63%.
And the intuition starts with the fact that the rule could be exactly wrong in all cases. So let's understand that. So most people think of an investment opportunity where the costs are up front and the benefits are later on.
Yes.
But imagine an investment opportunity where the costs are later on and the benefits are up front. When I teach the class, I teach a very salient example, which is if you're a textbook author, often the way that works is they pay you a upfront advance and then you have to incur the cost of writing the book. In that case, the internal rate of return investment rule gives you exactly the wrong answer. And the reason is you're essentially getting a loan. So if you're doing a regular investment, I tell you the internal rate of return, that is the break-even discount rate, exceeds the actual discount rate. And then you say, okay, that's a great deal for me, so I should take it. But if you get a loan, and I tell you the rate of the loan exceeds the discount rate, you're going, no, I don't want to pay that high interest. And so you could think of the royalty example as really a loan because you get the money up front and then you have to make the payments later, which is the way a loan works. Well, the way you get multiple IRRs is after the end of the work on the textbook and you've paid the advance back, you eventually start getting royalties. And so it becomes a mixture of a loan and an investment. And because of those mixtures, the shape of the NPV curve can be U-shaped so you can get multiple IRRs.
So related to the example I gave earlier, Jonathan, about the discount rate telling you how important the future is, now the good stuff that you're talking about comes first and the bad stuff comes later. So obviously, if you now increase the discount rate, you make the bad stuff less important rather than the good stuff. And so therefore, the whole intuition switches around. And so indeed, you have that issue that now the IRR rule gets it completely wrong, and you have to really be careful. But once you start to indeed mix scenarios, and some of the benefits happen in the future and some of them happen now and some of the costs happen in the future, once you start to play with the discount rate, what are you making more important relative to the other piece can totally depend. And it's not even that you can just get a U-shaped curve for the IRR. If there are multiple good and bad things happening in the future and they alternate, you can really get tons of different solutions for the IRR. And now the question is, what am I supposed to do with that? If I get 6 different answers, what should the rule now be?
Jules, this is well and good, but many students, when I teach this, go, oh, it's being technical. We can reverse the rule when
needed,
when the cash flows come first.
Yes.
And there may be some truth to that. I always respond when they say that, well, having a simple rule that is invest whenever the NPV is positive is a lot easier than a rule that says invest whenever the IRR exceeds the discount rate, except for, and then a whole bunch of exceptions. But let's say you could do that. That I don't think there's still other issues with the IRR rule.
Yeah, so first, Jonathan, it's even possible that you don't get a solution at all. What if there is no break-even point? What are you supposed to do then? When your students ask the question, oh, you're being technical, I can just change the rule. Tell me how you're going to change the rule now if there isn't a solution.
Yeah.
Right? I always say to my students, if I would raise my children with a set of rules, and in every situation that they confront me with, I have to change the rule to make it work for that particular situation, that's called not a rule, right?
Exactly.
So the idea of rules should be that I can consistently apply them and that they work under all circumstances. Otherwise, what are we really doing? But now let's go to what is an even bigger problem with the IRR.
Well, one of the biggest problems with the IRR is what I would call scale, which is very closely related to another problem, which is the timing of the cash flows. But let's just talk about scale because it's easy to understand. As I tell my students, what would you rather have? 100% return on $1 or a 10% return on $1 billion? And it's pretty obvious. You'd much rather have a 10% return on $1 billion. But the IRR rule, since it's in returns, it's tempting to say, I'd rather have a 1,000% return than a 10% return. It ignores scale.
Yeah, for sure. And so, of course, the implicit assumption that people make when they use the IRR is that you can somehow make the scale irrelevant. People say things like, well, if you can get that super high return that you just mentioned on the $1, why couldn't you just get it on the $1 billion too?
And that, I think, is one of the most fundamental mistakes certainly academics make. Probably business people don't make that mistake. It's probably business people fully understand the decreasing returns to scale in every single business. In other words, it's suboptimal to operate in the increasing returns to scale part of the production function. If you've got increasing returns to scale, increase the size of the business. And so any competent business is going to be operating in the decreasing returns to scale part of the production function, which means scale matters, and which means you cannot use a rule that ignores scale. And it's very closely related to the timing of the cash flows. Because if you remember, the rule is usually stated on a per annum basis. So if I tell you you make a $1,000 investment today and you will get back, say, $200,000 in a year from now, or $200,000 in 5 years from now, the internal rate of return is going to be different because it's stated on an annual basis. And then you'll say to me, well, of course it's different. You're getting the cash flows later. Yes, that's true. But let's say you were getting the cash flows later, but the cash flows were growing at a rate. It's not then clear the IRR rule gets it right, because it depends very much on the rate at which those cash flows are growing.
Absolutely. And so, Jonathan, now is a good time, I think, to talk about the paper that we have, right? Because a lot of people say the problems that you have pointed out, they can occur, but there are also many situations where they don't have to occur. And aren't we just fine? And shouldn't we just try to avoid those annoying scenarios where the problems occur and just stick with the good parts of it, which is let's just hope and cross our fingers that we're not in that part. And so the paper that we wrote, I think, makes a very strong point, which says that as soon as you can change the timing of the cash flows through payment plans, so as soon as you allow for financing of your investment, meaning, for example, that you don't have to make the full investment in a machine or in a plant or in a car today, but you're allowed to pay it off with a payment plan over time, which of course is the same thing as essentially taking a loan for the investment that you're making. There exists a payment plan for every single positive NPV investment where you can make these problems occur. Meaning that the scale can be made such a problem that essentially, if you can choose the payment plan, you can make the IRR any number that you like higher than the original IRR that you got when you financed the whole thing up front. You can come up with scenarios where you get multiple solutions. You can have a payment plan for which you have no solutions. So for that reason, these pathologies of the IRR, they're not just incidences. They're such structural problems that they're ubiquitous all the time.
Yeah, so let's just state what the result of the paper is, which is if you allow financing, every single project will have a problem with IRR. If you allow any financing. Before we explain that, let's just start with the intuition. And let's start with a very simple question. Maybe some of our listeners have already thought about this, some of our very intelligent listeners, and they would have said, Jonathan, you're telling us IRR is a terrible rule, but essentially that's the rule investors use every day in the markets. And it's true. When investors do a market investment, they calculate the rate of return on that investment, which is essentially the IRR. And you're saying, well, Jonathan, surely, according to you, that means I'm making mistakes all the time. And my students ask me, my very brightest students who are on the ball, this is what they say to me when we start doing capital markets in that course. And the answer is very simple. An investment opportunity in the market is usually a very simple opportunity, which is there's limited liability. So the first cash flow is negative, you buy. All future cash flows are positive.
Yeah.
So that immediately means there's only one IRR. And the second crucial part of the investment is we always assume that an investor is small. And what that means is the investor does not affect the price. And that's equivalent to you can invest at any scale. So the scale problem goes away.
Yeah, let's say definitely indeed. We assume that the scale problem isn't there because assuming that the investor is small is the same as saying there is no scale problem. Let's be precise, right?
Exactly.
Yes.
And so the first thing I point out to my students is that's true for you and me. It's not true for a mutual fund manager.
Or for Elon Musk.
And, the work that Jules and I have done in mutual funds is precisely predicated on people making the mistake that a mutual fund manager makes an investment and he doesn't affect the price. And that if you realize that that's of course unrealistic, then no, you cannot use the IRR rule to evaluate a mutual fund manager. No. But keeping on that intuition that if you're small and you don't affect the price, notice something, that we always think about it as an investment where we ignore financing. But if we did not do that, then the IRR is arbitrary. Because by simply financing, by buying on margin, you can change the return of your investment. So there's no fixed return on investment if you allow people to buy stock on margin. So there's another implicit assumption, which was always talking about the return with no financing. And so now let's think about the idea of a project where you allow arbitrary financing.
Now, so Jonathan, one thing that we need to add to that, right, is that there's even a link between allowing for financing and assuming that the scale is so small that you wouldn't affect the price. Because if I can aggressively use financing, I can increase the scale that I have to an arbitrary number that I like.
Exactly. So really, the set of conditions where you can use the return to evaluate an investment opportunity is very, very small. Like, for example, private equity, people love to use IRRs to evaluate their performance. It's just incorrect in that context. In that context, the scale is very limited. The timing is very specific. And so using IRR in the private equity context, I think, is one of the big mistakes less sophisticated investors do. I think more sophisticated investors understand. And when they are given historical IRRs, they take those IRRs with a grain of salt.
And there's one more thing that we need to talk about, Jonathan, that the paper shows, which is that if you take financing, you can boost your IRR. But if you take financing at unfavorable rates, you may still boost your IRR and yet undermine your NPV, meaning you are really hurting the total value that you're extracting, but you're making your IRR numbers look good. So a really prevalent example of this, particularly in the sector that you just described, is if you know that somebody uses IRR and you ask them, would you rather pay for the investment up front, or would you rather take a leasing plan at an unfavorable interest rate? If the person uses the IRR, they will pick the leasing plan at the unfavorable interest rate and destroy value just to make the IRR look better.
Yes, and Jules, I think we should talk about the example you came up with that I use every year after you came up with it. It's such a beautiful example. You came up with an example where you said, okay, let's just consider an investment, positive NPV investment, standard and positive NPV. The person makes an investment and it pays off in a year, say. And then what you do in that example is introduce a financing plan where instead of making the investment today, you only invest 1 penny today. And then you pay it back in the future when your revenues come. And obviously, that IRR is close to infinity because you're investing a penny and you're getting something in the future. And you can invest half a penny and a fraction of a penny. And each time you reduce the investment and move the money to the future, you send the IRR to infinity. So the first part of the example you came up with is to show students they can pick any IRR they want, just based on how much they want to invest today using the financing plan. And then the second part of the example you came up with, which I think is beautiful, is you then consider a financing plan at too high a rate, such that what happens is the person borrows almost all the required investment, leaving just an epsilon amount that they have to invest. And then in the future, the payout has to be a lot higher than epsilon.
Exactly. But if epsilon is small, then the ratio of the payout to the investment is still a very high number. In other words, you can send the IRR to infinity, but if the financing rate is sufficiently above market, you can send the NPV towards zero. So by taking an unattractive financing plan, you can generate a project for which the NPV approaches zero while the IRR approaches infinity.
And all the money goes to the person financing the project. It's a wonderful example, very simple example of if you use the IRR rule, the financing person can take the NPV away from you.
Yeah, and I think that is a very important theme in finance in general, Jonathan. But today in class, we had a long discussion about this too, where people were telling me like, well, if everybody uses EBITDA multiples, why shouldn't we be using it? And I said to them, just like with the IRR, if I know you're using the wrong decision-making criterion, I can manipulate you, because if I know what the right decision-making criterion is and I know you use the wrong one no matter what, then, I can take advantage of you.
It's a very good point, Jules. Excellent point. And that's something that's so important. And, I just feel as if as finance professors, we don't emphasize that enough. When I talk about the NPV rule, at one point early in my career, I taught a class to undergraduates and it was great. And then one of the undergraduates, one of my best students, came to see me afterwards, and then he was telling me that he was taking an accounting class. In the accounting class, they were using the IRR rule, and he said to the professor, no, Professor Berk said, got to use NPV. And the professor started arguing with him, and he said to me, I couldn't argue back, Professor Berk, why do you use the NPV rule? And I was like devastated, because it was quite clear I hadn't taught anything. And from that day onwards, I said I would make sure that my students understood. And when I sit there and teach NPV, I say to them, the NPV rule answers the only question you're interested in having answered, which is how much money can I make on the investment opportunity? Any other rule, if it answers that question, it has to be the NPV rule, because the NPV rule answers that question. And if it doesn't answer that question, then it's not telling you how much money you can make on the investment opportunity. It is telling you something else.
Yes, for sure.
And as we say, since it's telling you something else, somebody can manipulate you.
Yeah. I love that example. I mean, Although I would say, how much value do you add? And that, of course, is the same as the amount of money that you make, agreed. And indeed, in the end, a good decision can only be based on the correct decision-making criterion. So if I have 3 decision-making criterion and they give me 3 different answers, what am I supposed to do with that?
Well, they can't. As you point out, there's always a best way of doing something.
Yes.
So you can't have 3 best ways of doing something. And as it turns out, if your objective is to make as much money as possible, or to add as much value as possible, that's the NPV. Those are synonymous. So any other decision rule is not optimal. It's not giving you what you want.
And so the most surprising answer to me that I get from people is, yeah, but doesn't the IRR give the same answer as the NPV rule in many cases? So is it then fine? And then I'm like, well, but if it's giving the same answer, then what do you need the new decision-making criterion for? Didn't you already have the decision-making criterion then?
But it isn't. It does not give the same answer as the NPV. We just gave examples where it doesn't. And that can be used to manipulate the situation. Thanks for listening to the All Else Equal podcast. Please leave us a review at Apple Podcasts. We love to hear from our listeners. And be sure to catch our next episode by subscribing or following the show wherever you listen to your podcasts. For more information and episodes, visit alelseequalpodcast.com or follow us on LinkedIn. The All Else Equal podcast is a joint production of the Lauder Institute at the University of Pennsylvania and the Graduate School of Business at Stanford University, and is produced by University FM.